I call this meeting of the NCUA Board to order. Good morning, everyone.
Good morning.
Good morning.
Before I call the first item on our agenda, I would like to welcome several folks. I'd like to begin by offering a great welcome to our state examiners and their lead instructor, Greg Marshall. They are all here in Alexandria for Step 5 examiner training. Could you all please stand so we can recognize you? Here, here. Welcome, welcome. Thank you all. We're so delighted to have you with us. I'd also like to welcome several representatives from the Northwest Credit Union Association who are also joining us today as they come to DC to hike the hill. You're welcome to stand as well so we can acknowledge you all. Thank you. Again, we are all delighted you're here. You honor us with your presence. The first item on our agenda today is the Share Insurance Fund Quarterly Report. Staff presenting, Rendell Jones, Chief Financial Officer.
Good morning.
Good morning.
Good morning.
I'm here to present the 2019 first quarter statistics for the Share Insurance Fund. The first table shows the Share Insurance Fund's revenues and expenses for the first quarter of 2019. For the quarter ended March 31st, the fund recorded net income of $16.1 million. Total income of $80.3 million consists primarily of investment income from Treasury securities of $76.3 million. Additional income sources include $3.7 million collected for guarantee fees on the NCUA guaranteed notes, or NGNs, and about $300,000 of other income from interest on the building note, insurance examination fees, and counseled capitalization deposits. Operating expenses were $45.5 million for the quarter. The provision for insurance losses increased by $39 million during the quarter. The specific reserve increased by $40 million, while the general reserve decreased by $1 million. I'll discuss the change in the provision for insurance losses on slide 5. The natural person credit union asset management estate loss expense shows a reduction of $3.6 million due to favorable changes in the estimated future cash flows of assets held by certain natural person AMEs. The corporate asset management estate loss expense decreased by $16.7 million due to favorable changes in the estimated future cash flows of legacy assets in the NGN program. The next table shows the Share Insurance Fund's balance sheet as of March 31st, 2019, compared to the previous quarter's balance sheet, which was year-end. For the quarter ended March 31st, the Share Insurance Fund's total assets are valued at $16.2 billion, of which 93.9% of assets are funds held with the U.S. Treasury in cash, overnight investments, and Treasury notes. Overall, total assets increased $364.4 million, or about 2.2%, due largely to capitalization deposits billed in March and an increase in the market value of investments held with the U.S. Treasury. The receivable from natural person credit union asset management estates is $425.5 million, which increased nearly $17 million, primarily due to credit union liquidation activities, offset by collected asset management estate recoveries. The receivable from corporate asset management estates is $299.6 million, which increased about $10 million from the previous quarter. This increase results from a reduction in insurance losses due to favorable changes in the estimated future cash flows of the legacy assets in the NGN program. This receivable is typically reduced by cash collections for recoveries such as bond maturity, sales of assets from the AMEs, and legal recoveries. Accrued interest in other assets is $84 million, which increased about $13 million, or about 18%, largely due to an increase in accrued Treasury interest receivable. Total liabilities are $457.6 million, or about 2.8% of total assets. Accounts payable of $142.3 million primarily consist of capitalization deposit refunds due to eligible credit unions. The board approved a $160.1 million of dividends payable to insured credit unions in March. On Tuesday of this week, the agency distributed the 2018 dividend for over 5,500 eligible institutions. and statements were mailed to dividend recipients last week. This is the second largest distribution to credit unions in the history of the Share Insurance Fund, and only last year's distribution of $735.7 million was larger. Since the closure of the temporary corporate credit union stabilization fund in 2017, NCUA has issued nearly $900 million in equity distributions to eligible institutions. More information on the Share Insurance Fund distribution is available on ncua.gov, including 2 frequently asked question documents which address topics such as dividend eligibility, for example, which is any institution that filed a call report as a federally insured credit union for at least one reporting period in 2018. Other questions include how NCUA handles mergers and other events in the distribution of dividends, and accounting guidance, including how to report the dividend on the call report. If credit unions have questions regarding the dividend, they should contact my office at ncusif@ncua.gov, and that information is also on the website. The next item is the Share Insurance Fund's Insurance and Guarantee Program Liability or Reserve, which, as I indicated, will be explained in the next slide. The fund's net position is comprised of capitalization deposits, which represent the total balance of all federally insured credit unions' 1% capitalization deposits and cumulative results of operations. Net capitalization deposit activity increased by about $83 million this quarter. The balance of cumulative results of operations decreased by nearly $51 million during the quarter due to the previously mentioned $160.1 million dividend offset by unrealized gain on investments of about $93 million and $16 million in net income for the quarter. On slide 4, Share Insurance Fund reserves increased in the first quarter from $119.1 million to $155.2 million. The general reserve decreased by about $1 million for anticipated losses, and specific reserves increased by $40 million during the quarter for a net of $139 million. Each quarter, NCUA assesses the specific reserve needs for credit union failures when the loss is probable and estimable. The Share Insurance Fund paid $2.9 million for the cost of liquidations during the quarter. And reserves at quarter end totaled $155.2 million, with $44.4 million for specific reserves and $110.8 million for general reserves. On slide 5, as of March 31st, 2019, the Share Insurance Fund had $15.2 billion at par value invested in Treasury securities with maturities out to February 2026. The weighted average life of securities held by the Share Insurance Fund is 2.2 years. The weighted average yield of securities held by the Share Insurance Fund is 2.02%. Last night, we invested about $2 billion at a rate of 237 basis points, earning approximately $133,000. The second bar chart shows a cumulative picture of how much of the portfolio will mature over time. For example, about 92% of the portfolio will mature over the next 5 years. During the first quarter of 2019, 2 Treasury notes matured in a total amount of $100 million, and these securities had yields ranging from 0.91% to 1.34%. On slide 6, turning to the equity ratio, the current equity ratio as of December 31st, 2018 is 1.39%. The ratio is based on an insured share base of $1.1 trillion at December 31st. The blue line represents the normal operating level set at 1.38% in December of 2018. The number of Camel Code 4 and 5 credit unions increased by a net of 9 during the first quarter of 2019 for a total of 202. Of these credit unions, 86% have less than 100 million in shares. Approximately 13% have more than 100 million in shares but less than 500 million. And the remaining 1% have more than 500 million in shares. The total shares represented by credit unions that are Camel Code 4 or 5 is $10.4 billion, or about 0.91% of all insured shares. There was a 2 basis point decrease compared to the ratio at the end of the last quarter. Comparing Camel Code 4 and 5 by asset size from December 2018 to March 2019, total shares decreased by about $0.2 billion, 200 million, or 0.8% to $10.4 billion, and total assets remained at $11.8 billion. The number of Camel Code 3 credit unions decreased by a net of 35 during the first quarter of 2019, for a total of 905. Of these credit unions, 89% have less than 100 million in shares, 9% have between 100 million and 500 million in shares, and 2% of these credit unions have more than 500 million in shares. As of March 31st, total shares in Camel Code 3 credit unions were $43.4 billion. This is a $2.2 billion or 4.8% decrease from last quarter. Camel Code 3 credit unions represent 3.8% of total insured shares at the end of the first quarter of 2019, which is a decrease of 19 basis points from 3.99% at the end of the last quarter. Comparing Camel Code 3 by asset size from December 2018 to March 2019 show the total number of credit unions decreased in all asset categories except for credit unions above $1 billion in total assets. Camel Code 3 total shares decreased by a net of $2.2 billion or 4.8%, and total assets decreased by $2.2 billion or 4.2%. Slide 11. This slide shows the distribution of assets by Camel Code. The red portion of the chart is the percentage of total credit union assets that are Camel Code 4 and 5. The green represents the percentage that is Camel Coded 3, and the blue represents the percentage of credit unions that are Camel Coded 1 or 2. The distribution of assets over the last quarter increased by 0.1% for Camel Code 1 and 2 credit unions and decreased by 0.1% for Camel Code 3 credit unions. Assets for Camel Code 4 and 5 credit unions remained unchanged. In the first quarter of 2019, there was one credit union failure that incurred a loss to the share insurance fund. The failure was an involuntary liquidation with a purchase and assumption agreement. The cost of that failure for 2019 was $40 million. There was also an additional failure that resulted in no loss to the fund. For 2018, there were 8 credit union failures, 6 of which were involuntary liquidations with purchase and assumption agreement. 1 was a regular involuntary liquidation and 1 unassisted merger. The total cost of failures in 2018 was $792.5 million. Fraud was a contributing factor in the failure that incurred a loss to the share insurance fund during the first quarter. This concludes my presentation. I'll be happy to answer any questions.
Great. Thank you, Rendell. I don't have questions, but I do want to thank you and your team for your remarkable stewardship of the share insurance fund. And I'm sure many credit unions join me in thanking you for the $160 million in dividends that were dispersed earlier this week. Mr. McWaters, do you have any questions?
Thank you, Mr. Chairman. Just a couple, Rendell. Page 2, could you go over with us again the AMA loss expense reductions for both the natural person and corporate and what that means?
Sure. For those 2 reductions, generally it's a reversal of prior bad debt expense. And in those, 2 things generally drive it. Actual recoveries from assets held in the asset management estates or estimated future cash flows that are projected to be higher than we previously indicated. And so as a result, some of the prior bad debt expense is reversed for those 2 receivables.
Okay. And page 6, where we have the equity ratio as of December 31, 2018. After paying the dividend, is it fair to say that the equity ratio and the normal operating level are both 1.38%?
Yes.
Okay. Thank you. That's all.
Great. Thank you. Mr. Harper.
First, Rendell, I want to echo the chairman's comments and thank you and your team, including staff from the Office of the Chief Information Officer, for successfully processing the recent share insurance fund distribution to credit unions. You certainly learned from last year and built on the distribution process and were able to process these payments expeditiously. You've also been very detailed and transparent in describing how the payments are calculated, and I believe that transparency is very important for the agency, so I want to thank you for that. Would you mind going to slide 3? Rendell, I just want to refresh my memory because I've been out of the agency for a few years. Correct me if I am wrong, but when we look at the net position on capital deposits and the net position on the cumulative results of operations, it's that 4.3 billion that is held by the agency, and it's the 11.4 billion that are held by credit unions on the deposits on their books. Is that correct?
The 11.4 is reflected as an asset on the books of credit.
Correct. Okay, great. And together, those roughly get to the 1.38 current reserve ratio.
That's the numerator generally for
Great.
the reserve ratio.
And then just one other question. Where does our ratio stand vis-a-vis the banks and the deposit insurance fund? I know that they are building up their level. I believe it's to 2%.
The FDIC, according to their public reporting, has a target ratio of 2%.
Great, thank you. Moving on, I just want to make sure that when we talk about the distribution most recently of $160 million that the agency just made, am I correct that there is nothing extraordinary in this upcoming quarter's report?
That's correct.
Great. On slide 12. Great. You've added a line displaying the total assets of failed credit unions, and that shows a sharp spike there in 2018 with nearly $1.6 billion in assets in failed credit unions. That's dramatically higher than the previous years, where we've seen only about $200 million in losses. I want to thank you for adding this line. I think it increases our transparency and disclosures. Correct me if I'm wrong, but that spike is largely due to the failure of taxi medallion credit unions.
That's correct.
Now that the funds have been set aside for anticipated losses, do you anticipate any changes in the distribution of our portfolio?
So we still are managing for safety first. So the three principal objectives on the investments for the fund is safety, liquidity, and then yield. So yes, we do have some obligations associated with the NGNs coming up in the next year or two. So we do look at the position there, but are always reevaluating. In fact, we met this week to discuss it.
Has our need for overnight or short-term funding changed now that we've gotten through the taxi medallion crisis?
So we anticipate we will revisit it in the near future, but keeping in mind our assessment of risk in the system overall, and sort of knowns that I just mentioned associated with the payments we will owe for the NGNs that mature in 2020 and 2021.
Great. Could we go back to slide 11? The distribution of assets and Camel codes. This is really one of the most important slides, and I've looked at this slide for years. We continue to see a very small sliver of Camel 4 and 5 credit unions, and a healthy and relatively constant number of Camel 1 and 2 credit unions, as well as a slightly declining number of Camel 3 credit unions. This is overall much better today than certainly where we were back in 2014. When you briefed me before today's meeting, I asked you to expand this timeline so that we could look at the period before the Great Recession rather than just the last 5 years. I believe that's shown on slide 17, which is part of your appendices. Would you concur that under this longer time frame, this longer time series shows that while the number of troubled credit unions and failing credit unions increased dramatically during the Great Recession, the system has recovered and is now probably as strong, if not stronger, than we were before going into the Great Recession?
Agreed.
Finally, if I could go to slide 16. Rendell, one last question. Should we be concerned that our yield is now below both the 90-day T-bill and the 10-year bonds? Or is this an expected outcome of an investment strategy that prioritizes liquidity and stability over chasing short-term yield?
That is correct. And if you compared it to a year ago, it's up about 30 basis points.
Great, thank you. I have no more questions.
Great, thank you.
Thank you.
The second item on our agenda is the update of the Office of Credit Union Resources and Expansion. Staff presenting, Martha Ncaa, CURE Director. Welcome.
Good morning.
Good morning. Good morning.
The Office of Credit Union Resources and Expansion, known as CURE, was formed in order to assist credit unions with their growth and outreach efforts. CURE's mission or motto is to let us help you grow. CURE combines the regulatory support of field of membership expansion, charter conversions, and new charter requests with resources for credit unions. Resources include grants and loans through the Community Development Revolving Loan Fund and a streamlined application credit unions may use that are interested in obtaining the U.S. Treasury CDFI certification, plus free online training through our learning management service. My time before you today is to provide an update as to our efforts in further developing CURE's programs and services for credit unions. First, I'd like to start with new charters. NCUA staff are beginning to research how to modernize the charter process. The modernization effort will ultimately automate processes and streamline procedures. NCUA will have pre-developed business models that organizing groups may choose from. An example would be Model A would offer basic savings and loan products, and Model B would offer more online services. Based on the model type, organizing groups will be provided information such as lists of regulations to follow and types of policies required. Training will be available and offered to the organizing groups through our online training platform as they move through the chartering process. As a part of the modernization effort, NCUA will provide additional tools to assist organizing groups. In July, we'll be launching an online portal for organizing groups seeking to charter a new credit union. Through a series of screens, this online portal educates organizing groups of the chartering process. It assists in identifying the purpose and core values of the credit union, the type of field of membership, including whether or not the institution will be a minority depository institution. In addition, and in fact, right after this board meeting, a new low-income designated area workbook will be available online on NCUA's website. The LID area workbook lists that counties, census tracts, census block groups, and zip codes within the United States and Puerto Rico that qualify for NCUA's low-income threshold. Credit unions may further their outreach efforts by specifically targeting potential new members residing in one of the low-income designated geographic areas within the field of membership. Towards the end of this year, NCUA will launch a capital estimator tool to assist organizing groups to gauge how much capital is required based on the types of risks associated with the new credit union. The goal of the modernization effort is to make the process more transparent for organizing groups to establish a new credit union. We'll continue to inform the credit union industry as the modernization process continues. Next is the Minority Depository Institution Preservation Program. The NCUA's MDI program is designed to provide needed support to those credit unions that serve communities and individuals who may lack access to mainstream financial services. The NCUA supports these credit unions through free online training that focus on specific issues faced by small and minority institutions. We also provide opportunities for collaboration via WebEx and teleconferences. If the MDI holds NCUA's low-income designation, MDIs have access to the Community Development Revolving Loan Fund grants and loans. Grant initiatives are tailored for small and minority credit unions to assist them in their growth and outreach efforts. One of NCUA's 2019 strategic plan indicators is to award funds to 40% of the MDIs applying for grants. Beginning June 2nd through July 20th, NCUA's Community Development Revolving Loan Fund launches its 2019 grant round. Through congressional appropriations of $2 million, credit unions holding the low-income designation are eligible to apply for grant funding. This year's initiative includes financial counseling certification up to $5,000, digital services and security up to $8,000, training up to $5,000, and a larger award, underserved outreach initiative of $100,000. For the underserved outreach initiative, credit unions will be asked to provide a written plan of how they intend to use funds to extend financial services to low underserved areas. As part of the CDRLF program, low-income designated credit unions have access to low interest rate loans up to $500,000 and urgent need grants funds to up to $7,500 for emergency situations, such as inability to provide financial services to members due to weather-related disasters. Another resource for credit unions is our learning management service. This free service provides 24/7 online training for credit union governance leaders, management, and staff. To access training, the individual needs to register on the LMS using the credit union's charter number. Once access is gained, the user can take online courses and tests and receive certificates of completion. Within the LMS, There are webinars and videos to view, all focusing on specific challenges faced by small, low income, and minority credit unions. And finally, infrastructure. CURE staff.
And Martha, can I just,
Sure.
LMS is Learning Management System?
Sure, yeah.
Thank you.
Yep, you're welcome. CURE staff are always looking for ways to make processes more efficient, not only for credit unions, but frankly for ourselves. Staff are reviewing field of membership processes and automating those processes where possible. As we progress, CURE will continue to look for ways to improve programs and services for credit unions. We are here to assist credit unions in their growth and outreach efforts, and I thank you for the opportunity to present.
Again, well, thank you again, Martha, for joining us this morning. I want to begin by thanking you and your team for the opportunity I had earlier this week to present a new credit union with its charter. The Alta Missouri Federal Credit Union, you all, is a tribe there outside of Tulsa, Oklahoma. And through CURE and its hard work, we were able to present the first credit union charter of 2019. So kudos to you and your team. I especially am happy about the fact that you are going to, in your $2 million grant offering for this year, they're going to be offering grants to help with cybersecurity. As I've mentioned in a lot of my remarks today, cybersecurity, I think, is one of the biggest threats facing the financial services industry. So the fact that you are equipping those credit unions with the skills and tools they need with your grant, I think, is greatly applauded. Another thing I wanted to call attention to is the fact that you are bringing out the online portal and other things that are really going to modernize the charting process. That's going to make it transparent. It's going to take a lot of the guesswork out. I applaud. In addition, the fact that, as we discussed in our briefing, that you're giving them a plethora of options. They all have an option A or a B. I think that makes it really streamlined. So, on not a question, it's just more thank you, thank you, thank you. And now for questions. Do you have any questions, Mr. McWaters?
Just a comment, I guess. But thank you, Martha. Thank you for the work you've done. The new chartering process has been amazingly sluggish over the last few years. I'm not exactly sure why, but as the chair said, this needs to be streamlined, needs to be easier. These are credit unions. We're not sending people to Mars here. You can make the rules more streamlined, but I think at the end of the day, chartering credit unions requires money. And the way historically credit unions have been structured is that they run on retained earnings. So you have a chicken and egg problem. You either have philanthropic support or perhaps a particular field of membership support for a credit union, or you don't. And if you don't, it's hard to get going. It's hard to launch your credit union. Once it's launched, it can run on the retained earnings very well. But that speaks to the need to strongly consider a supplemental capital rule to allow these de novo credit unions ways to have seed capital to jumpstart into their business. So thank you.
Thank you. Mr. Harper.
Martha, thank you for your informative update, and I want to associate myself with the chairman's comments about the cybersecurity grants. Cybersecurity is a very important issue for me as well, and certainly one of my priorities. And to the extent that we are able to assist credit unions on that issue, I think it's very important that we could and should do that. I also want to thank you for leading the consolidation of services into one office in terms of assisting credit unions. This one-stop shopping, it's going to be good to have all of those services in one place. I'm also particularly glad that you're tackling the difficult challenge of chartering new credit unions. We all know that the number of credit unions has declined dramatically over the last 30 years, even while a significant number of Americans remain underserved or unbanked overall. The problem of financial debts are also exacerbated by an equally significant, if not greater, number of consolidation in the banking industry and closures of bank offices in rural and low-income urban communities. Am I correct that the number of new credit union charters, while it's not large, the groups and communities served by these charters have been historically underserved or focused on persons of modest means?
Yes, correct.
Great. So our new charters are very true to our mission. Is that correct?
Yes, they are.
Great. Correct me if I'm wrong. The chairman went out to Oklahoma and announced the new charter, which I think is a wonderful thing. But work began on that 3 chairmen ago.
Mm-hmm.
That's quite a long time. Do you have data on the length of time it takes on average for a group to get a charter with us?
Depends. I mean, Board Member McWaters mentioned the length of time that it does take, but one of the reasons is because of the capital.
Sure.
So what we hope to do through the modernization process is research different ways that credit unions can find the startup capital so the process doesn't take so long.
Are there other ways in which you're working on in terms of new charters that could expedite the process in addition
Yes.
to just capital?
Yes, we're going to educate the organizing groups right up front through the online portal, taking them through a series of screens to educate them and inform them, you know, what's ahead of them as they move through the new chartering process. And then that will give them an idea of what they need to do as far as finding resources and support within the community that they're trying to assist.
Great. I know that when the chairman testified twice last week, and congratulations on that.
Thank you.
He spoke about the need to allow all credit unions to be able to add underserved communities, and I think I agree with him very much on that issue. Wouldn't such a change be especially helpful for community charters so they could add and serve underserved communities?
Yes.
And am I correct that many states permit broader fields of membership that enable state-chartered credit unions to serve more unserved and underserved areas?
Yes.
And that this has not resulted in any real great risk to safety and soundness?
Not that I'm aware of, no.
Great. Finally, it's come to my attention that our current rules do not allow individuals in the military who use an APO overseas military address or a military base address when calculating the low-income credit union designation. Yet we know that pay for our troops is often below the national averages, certainly perhaps getting them close to the 80% overall. Will your office work to look into this issue and develop a recommendation so that we might further examine it?
We would be happy to take a look at that, yes.
That's great. Thank you, Martha.
You're welcome.
Thank you again.
Thank you.
The last item on our agenda is Proposed Rule Part 701, Public Unit and Non-Member Shares. Staff presenting, Ian Marina, Associate General Counsel, Ben Litchfield, Staff Attorney, Office of General Counsel, Larry Fazio, Director, Office of Examination and Insurance, and Tom Fay, Director, Capital Markets. Welcome, gentlemen. Good morning.
Good morning. Good morning. We're here to present a proposed rule updating Section 701.32 of the NCUA regulations related to shares from public units and non-members, which we sometimes refer to as non-member deposits. Thank you. This change was initially outlined in the Regulatory Reform Task Force's agenda as a way to provide regulatory relief to credit unions by aligning the authority to accept and the amount that they can accept from public unit and non-members in terms of shares with a Crane's authority to borrow. Public unit and non-member shares have many of the same characteristics as member shares in borrowings. And when used responsibly, these can be a beneficial source of funding for Cranes, especially smaller ones. So we drafted this proposal with a few goals in mind. First, as identified by the task force, we wanted to provide responsible regulatory relief by giving Cranes greater flexibility to determine an appropriate funding structure to support prudent operations without requiring a waiver from the NCUA. Second, it allows us to reorient how the agency thinks about balance sheet management and funding sources into one that is more holistic. That is, credit unions in the agency should consider the overall risks associated with a Cranes funding structure, the characteristics of the funding, and the corresponding risk management practices utilized, rather than looking at funding sources in isolation. And lastly, this proposed rule provides some clarifications intended to increase consistency of application. So with that said, I'm going to turn it over to Ian, and he's going to talk about the current statutory and regulatory requirements and then detail the proposed changes.
Thank you, Larry. Good morning. As shown on the slide, the Federal Credit Union Act authorizes federal credit unions to accept shares from the following categories: members, other credit unions, non-member public units such as state and local governments, central liquidity facility, and for low-income designated credit unions only, other non-members, all subject to limitations prescribed by the NCUA board. State law determines which sources of shares state-chartered credit unions may accept. By regulation, in Part 701.32 for federal credit unions, in Part 741.204, which applies this regulation to federally insured state-chartered credit unions. All federally insured credit unions are currently limited to taking only 20% of their total shares, or $3 million, whichever is greater, in non-member and public unit shares. Note that for public units, this limitation applies even if the public units are members. The slide breaks down additional detail on these types of shares. Note that this limitation applies to low-income credit unions, though those credit unions have an additional source of shares that they can take under the statute from other non-members. Currently, credit unions may seek waivers of this limitation from the regional director by submitting a written request and a plan governing the use of the funds. The proposed rule, as shown in the next slide, has 4 key features. I'll point out the proposed changes. First, the proposal would change the basis for this limitation on these shares from total shares under the current rule to paid in and unimpaired capital and surplus, a term that means shares plus undivided earnings, with the caveat that public unit and non-member shares would be subtracted from this base. This change more closely aligns the base for purposes of this rule with the existing limitation under statute and regulation for insured credit unions borrowing, which is 50% of paid in and unimpaired capital and surplus. The reason for subtracting the non-member and public unit shares from the base is to avoid a circular effect where adding more shares increases the base, which in turn allows more of these shares to be taken in, and so on. Second, the percentage limitation would increase from 20 to 50%, with the clarification that this limit is measured at the time that the shares are taken in. Third, the waiver requirement would be eliminated. A written plan would be required only if a credit union's combined public unit and non-member shares plus borrowings exceed 70% of paid in and unimpaired capital and surplus. The plan would need to be available to examiners, but would not need to be submitted to the NCUA for prior approval. Fourth, the proposal specifically seeks comments on whether or not to retain the alternative 3% or $3 million limitation found in the existing rule. Now, the current slide gives an overview of the current and proposed rules and details on each of the elements that I just mentioned. And just as a reminder, both the current limitations and the proposal apply to all federally insured credit unions, including those that are low-income designated. With that, I will turn the presentation over to Tom to discuss the impact of the proposal.
Thank you, Ian, and good morning.
Good morning.
Good morning.
So I'm going to discuss the analysis of the proposed change credit union usability. As already noted, credit unions are currently subject to regulatory limits on sources of money and other memberships. Non-member deposits are limited to 20% of total shares. Borrowings are limited to 50% of paid-in unimpaired capital expenses. Under this proposal, non-member deposit limit increased to 50% paid-in unimpaired capital expenses. In addition, there's a practical limit on the amount of funding credit unions can obtain before their net worth would decline below 7%. Thanks, Jerry. The level necessary to be well capitalized for prompt corrective action, or what we call PCA. As reflected in slide number 6, the proposed rule would allow, on average, a credit union to increase its funding capacity from sources other than member shares from a current 56% of assets to 65% of assets. To take advantage of the proposed higher limit, a credit union would need a net worth ratio of at least 17%. The additional amount of potential leverage for the entire credit union system would increase by only 6% or an estimated $135 billion in total under the proposed based on current net worth levels. So with that, I will now turn it back over to Larry.
Thank you, Tom. So as Tom just noted, most cranes will be constrained by the amount of leverage they could engage in based on their net worth level. However, this proposal enhances flexibility for credit unions to optimize their funding structure. Today, cranes use member shares as their primary source of funding. However, as Ian noted, cranes do have the authority to accept shares from non-members and to borrow from any source. Some cranes do use one or both of these forms of funding successfully to achieve balance sheet management and strategic objectives. Additionally, the proposal provides potential growth opportunities for cranes with very high levels of net worth without the burden of needing a waiver. Generally, it is small credit unions that have high net worth levels, those that are high enough to take full advantage of this proposed new authority. So while this proposed rule would provide relief to all credit unions, it would likely benefit small and low-income designated cranes the most. Through the examination and supervision process, the NCUA will continue to review a crane's funding structure and characteristics to ensure they are consistent with prudent asset liability management principles and do not pose a safety and soundness concern. The Office of Examination and Insurance is in the process of updating examination procedures to ensure examiners analyze a crane's balance sheet from a holistic perspective, taking into account the sources and characteristics of its funding as it relates to interest rate risk and liquidity risk. So in conclusion, we believe this proposed rule would provide responsible regulatory relief without posing undue risk to the Share Insurance Fund. That concludes our prepared remarks, and we'll be happy to answer any questions you have.
Great. Again, thank you, gentlemen, for your presentation this morning. I look forward and I will be eagerly awaiting the responses that do come in, because while you've mentioned that this proposed rule will help all the credit unions, I share your belief that it will especially help those low-income designated credit unions, our MDI designated credit unions, and all just small credit unions in general. These are the folks who really are epitomizing that people helping people ethos. They're the ones that really are leading to low to moderate income and vulnerable communities. So I especially look forward to hearing their comments. I especially also want to hear about, well, that removal of the $3 million cap, is that something that will have a deleterious impact on their ability to get the capital that's needed? In fact, this so dovetails perfectly with Martha's presentation from earlier. I mean, anything we can do to optimize funding sources, I'm supportive of. The waiver removal process, I understand the waiver will be removed, which I in turn think that will in fact get more people to perhaps consider these sources, but they will need to complete a plan. So I hope that if this does make it to a final rule, that we will give guidance as to what that plan should entail, and also in turn work with our examiners to ensure that they have the resources they need. Other than that, I look forward to the responses. I have no questions. This was just a comment. Mr. McWaters, any questions?
Thank you, sir. I echo your comments, particularly ones with respect to smaller, low-income credit unions. But why is that? Why would this rule benefit smaller credit unions as opposed to larger credit unions? Is it because non-member deposits are easier to deal with in borrowings, that the cost of capital associated with non-member deposits is lower, or what exactly is driving this?
I think it's mainly two things. It's a variety of things, but it's mainly two. First, smaller cranes tend to have higher levels of net worth relative to their total assets. That's just the reality. Bigger cranes tend to have 9, 10, 11% net worth. The industry aggregate level is about 11.3, I think, as of year end. Small cranes tend to be 14, 15, 16, 20% net worth ratio levels on average. So they have the more balance sheet capacity to use leverage. Secondly, I think that for a smaller institution, borrowing can be a little more challenging, a little bit more daunting. Right. A deposit's more customary for them. It's a share certificate, it's a share account. And so maybe it'll make it a little bit easier. And it's also likely that could also be a lower cost source for them.
Okay. So what you're saying then on slide, I think it was slide 6, that 17% cap there was less likely to apply to a smaller credit union than a larger credit union, because smaller credit unions have higher leverage ratio.
On average, yes.
Okay. And the 17% is a mathematical determination. This is not set by us.
Right. It's just the
It
math.
just falls out.
It's just the math.
You increase non-member deposits, you increase assets, that decreases the denominator and all that stuff. Okay. Are non-member deposits more volatile to you than borrowings? In other words, if there's a crisis, let's say in small credit unions, or there's recession in the economy or whatever, the fact that we have permitted small credit unions to incur higher amounts of non-member deposits, would that be a problem then?
So I'm going to go back to my accounting 101 professor's preferred answer. It depends.
Hey, I've been there. In fact, I probably said that.
I suspect you have. So all else being equal, right? And so credit unions can use all of these funding sources: member shares, non-member shares, borrowings responsibly. They can do it irresponsibly, and the way that they take in those accounts and they structure those accounts can create different risk characteristics, right? That all have to be thought through and managed. So it depends. If I were going to make a generalization, I would say that the risk characteristics of the deposits are generally probably lower. But again, there's other ways to do it irresponsibly that would make it higher than, say, traditional borrowing. And there's a variety of reasons for that. Depositors have different behavior than a wholesale lender, an institutional lender. The borrowings typically come with, typically are secured, or they have a blanket lien on the balance sheet of the credit union, and that gives them more rights than a depositor might have normally. Many of the depositors are insured, so they have the protection of the insurance, so they tend to be more stable as a result. But again, it depends how much is uninsured. But if you were making a broad generalization, I would say on net, yes, it's slightly lower risk.
Okay, which is the reason going from 20% to 50% in your view does not create a safety and soundness issue to the share insurance fund.
Correct.
Okay, thank you.
Great, thank you. Mr. Harper.
Thank you, Mr. Chairman. First of all, I want to thank the Office of Examination Insurance and the General Counsel's Office for their work on this proposal. I must admit, when I first read this proposal, it was clear as mud to me. But as you walked me through the proposal and we made refinements to it, I certainly understand while this is in the weeds, so to say, mud and weeds. I'm not trying to mix my metaphors necessarily. Capital is king. And really what this is all about is making sure that credit unions have the capital, and that capital helps them to withstand crises when and if they should occur. Larry, am I correct, therefore, that you're recommending this rule because it will provide flexibility and regulatory relief to credit unions as they manage their balance sheets, but it will also simultaneously enhance liquidity and safety and soundness of both individual credit unions and the system?
Yes, it certainly has the capacity to do that.
Great. And while the proposed rule provides additional flexibility to many credit unions, there remain guardrails in place to protect both individual credit unions and the system. In addition to the cap on total public unit and non-member deposits and the new requirement for a plan of public unit and non-member deposits and borrowings exceed 70% of paid-in capital and unimpaired capital and surplus, the statutory leverage ratio is also an important guardrail, correct?
Correct.
Can you explain how the leverage ratio will be binding constraint for most credit unions?
Sure. So we're going to do fractions here, so bear with me. So the net worth ratio, which is specified by statute that cranes are subject to, or they fall into prompt corrective action territory, and the agency has to engage in progressive actions to remedy the decline in the capital level or net worth level. So we have what's called the net worth ratio. The numerator is net worth. The denominator is total assets. So when a credit union takes in funding sources, which is on the liability side of the balance sheet, right? You have assets on the left side and you have liabilities and equity on the right side. So as they take in liabilities from members or non-members or from borrowing, sources that are giving them a loan, they take in cash. So the liabilities go up and the assets go up. The assets, the total assets, are the denominator for the net worth ratio. So when a denominator goes up, the ratio goes down. And so there's only so much leverage. We tend to call funding on the liability side of the balance sheet leverage. There's almost only so much leverage you can do before you depress your net worth ratio to a point where you would run into PCA territory, less than 7% net worth ratio.
While the proposed rule requires a credit union whose public unit and non-member deposits and borrowings exceed 70% of paid-in capital and unimpaired capital and surplus to have a plan detailing how they intend to use those funds, am I correct that they will not have to obtain prior approval of that plan from NCUA, and that instead it will be reviewed by our examiners as part of their regular supervision and examination responsibilities?
That is correct.
And both our existing rule and this proposed rule require credit unions to use these sources of funds consistent with prudent risk management principles. Can we assume that our final rule, should we decide to move forward with this on a final rule, or agency guidance will give more detailed advice to credit unions on how to comply with prudent risk management principles?
Yes, thank you. Our intent would be with a final rule that if the board does want to finalize this rule, that we would provide more details about safety and soundness expectations and expectations around the plan in both the preamble to the final rule as well as the guidance we give to examiners about how to examine for this area.
I think that's very important. Thank you, Larry. Would you also describe the characteristics of credit unions that have obtained waivers of the existing 20% threshold or who may be near the threshold? Are they large multi-billion credit unions, medium-sized credit unions, or are they predominantly small credit unions?
We'll let Tom handle that.
Sure, Tom.
Existing waivers?
Existing waivers, yeah. The characteristics.
Primarily small. The characteristics, I'm just going to go to a slide because I was preparing for that question. Thank you. We've seen waivers for credit unions between $10 million and $360 million. And largely small amounts of non-maturity, non-member share amounts. I don't think, when we grant a waiver, they're usually for a period of 2 years, obviously, because the credit union is trying to emerge into a safer and sounder financial condition. So I think this is a good bridge. And so we look at those characteristics in their plan as to how they would progress out of this.
Great. So am I correct then in assuming that this rule is not aimed at helping big credit unions to get bigger, but rather is aimed at helping smaller credit unions to provide an additional tool for them?
Yes.
Great.
Can I just add to that thought?
Sure.
It does give especially smaller credits the ability to grow, achieve economies of scale, but it gives all credits more flexibility in optimizing their funding structure. So it's not necessarily growth oriented, but it might be the mix. Diversification and a shift in the mix that would also provides an advantage to all credit.
Great. And so, Larry, I will be supporting this rule, but I want to assure everyone in the room that I am supporting this rule, proposed rule, based on the evidence before me, and that the pragmatic, I'm not supporting this rule because you're wearing those wonderful Cubs cufflinks here at the table. I'm particularly interested as we get comments on this proposed rule, learning from individual credit unions, not just trade associations, how they plan to use this new authority. I recognize that small credit unions are strapped for resources and may not necessarily have the time to commit to this, but I think it's very important to hear from them so that we get this done right in a final rule. I also want to hear from state supervisors about any limits that they have in this area for state chartered credit unions and whether they think additional flexibility will strengthen the system and enhance safety and soundness. I additionally hope that commenters will identify any unintended consequences related to this change so that we can address them in the final rule. And finally, I especially want to hear comments on whether we should retain the existing ability of smaller credit unions to have up to $3 million in funding from public unit and non-member deposits. It's my understanding that the $3 million option is helpful to smaller and newly chartered credit unions, so I think we should focus in on that. And I believe we asked that directly in the final proposed rule. With that, I will support this rule, Mr. Chairman.
Great, thank you. Is there a motion?
Yes, I move that the board approve proposed rule, Part 701 of NCUA's Rules and Regulations for a 60-day comment period as attached to the board action memorandum.
Is there a second to the motion?
Second.
All in favor say aye.
Aye.
The motion passes. Thank you, gentlemen. Before we adjourn today, there are a couple of special items I would like to recognize. While there are many important proclamations and commemorations celebrated in the month of May, I'd like to bring special attention to two that directly relate to financial services and financial outreach. First, May is Older Americans Month, and I would like to highlight the online education resources NCUA provides to help older adults manage money and protect against fraud and exploitation. NCUA strives to connect older credit union members with important information to create greater personal financial security and contribute to their overall well-being. I invite you to visit the Aging and Managing Finances section of the mycreditunion.gov website for more information on these important resources. Second, I'd like to also recognize that May is National Military Appreciation Month. Each year, we remember the important role the U.S. Armed Forces have played in the history of our country. NCUA protects the deposits of many military members and their families through our defense credit unions. These credit unions provide important and invaluable financial services and resources to help those protecting our country and the pursuit of freedom. Please, please join me in celebrating and honoring the current and former members of the U.S. Armed Forces. This is the end of our agenda today. There being no further business, we are hereby adjourned.